In the late 70s, there was a popular movie with a popular theme song. The chorus, and I'll spare you my incredibly deficient singing voice, was, "Grease is the word. Grease is the word that you heard." However, today, the word is not grease. Today, the word you heard is inflation. The word we heard and the word we will continue to hear is inflation. And on this month's market update, we will discuss why inflation is the word and why you should pay attention to it. Hello, I'm Jeff Moss, and welcome to All the Right Moves. Welcome to the October market update. Inflation is here, but is it here to stay, and why should you care? Inflation has reached its highest point in 14 years, when it peaked at about where it is now. However, in 2007, it made a quick retreat south. Not so now. Until a few months ago, inflation has hung around the 2 to 3% per year mark. And that's where the Federal Reserve, or the Fed, likes it to be. 2% is pretty healthy and manageable. When it starts getting to 5% or above, like it is now, things start to go wrong. Interest rates go up, housing prices go down, and this is what we saw in the past when inflation went up. But home prices do not always go down during inflation. Some economists say that inflation will help keep home prices going up. History does show that. See, back in the 70s to the early 80s, home prices went up. However, rates were high then, and when rates got too high, home sales took a hit until rates started heading down to the 10% mark. Can you imagine paying 10% interest on a home? But that's the key. Rates are not 10% now. They are low. Even after going up recently, they are still low. How high will they go? It depends on inflation. Rates appear to be headed back up to pre-COVID levels, and that's to be expected. The real question is, how long will inflation continue to rise? As always, it depends on the amount of government spending, including spending to prop up the economy, and of course, regulation. As Congress spends more money and the Treasury prints money, inflation will creep up. I predict we'll see 4% or close in interest rates next year. But how does that affect home prices now? Rates are a key factor in affordability. The higher the rate, the higher the payment. The higher the payment, the less people can afford to buy a home. Right now, it seems like the market is slowing down. In reality, in September 2021, we were doing better than in 2019, which was a great year. Yes, home sales have slowed down a bit, but only when compared to a monumentous year for real estate. Home sales are very difficult to predict. According to Ivy Zelman of Zelman & Associates, closings are set to decline roughly 10% year over year in second half of 2021, and home price appreciation is on the cusp of flipping to a decelerating trend. Personally, I agree. I think we'll see a slowdown during next year as the rates go up. When people are uncertain, they sit still, just like during the COVID lockdowns. I also think it'll be regional and temporary, unless inflation continues its upward movement. And if the government continues to spend trillions, it may cause another global recession. Definitely not like it was in 2008. That was unique. Home prices will not drop like it did then. Of course, I could be completely wrong. And here's the home appreciation prediction from Pulsenomics for the next 4 years. They predict a steady and stable increase in prices. I like their prediction. I just think it's a little too optimistic. But hey, I am rooting for them to be right. And on that ambivalent note, that's it for our show. Thanks for watching. We'll see you next time on All the Right Moves with Jeff Moss.